This is a download from BFM 89.9, the business station.
Good morning, Dodge. Warren Buffett's Berkshire Hathaway and other fund managers are buying into General Motors shares that the U.S. government is selling. What is this saying about General Motors and the U.S. auto sector in general?
Good morning, Julian. It actually says more about the year-to-date performance of GM and the positive potential future prospects than it actually does the current stock price or the shorter-term stock potential. There are two elements to it. First, the big short-term positive is that GM has now returned to the S&P 500. It returned to that index during the second quarter, which is a milestone resulting from, in great part, due to the fact that the U.S. Treasury is reducing its stake. Index funds and similar ETFs must buy the stock now once it is included in the index. And as part of that, the demand for GM is being caused by the fact that autos represent less than 1% of this S&P 500 index. So it results in as close to an out-of-the-benchmark investment opportunity as one can achieve. The other element of that's positive is much more fundamental, and that is GM is introducing 18 new and refreshed vehicles in the U.S. and it's transforming its lineup from one of the oldest to one of the newest in the industry. These include the Impala, which has received Consumer Reports magazine's highest rating among all sedans. This is the first time in over 20 years that a U.S. automaker has outscored all Japanese and European competitors. So that's very positive. And some other fundamental improvements include they've drastically cut their labor costs. The average age of the U.S. car now is at a record 11.4 years. So there's a lot of demand pent up. And there's an increase in demand for cars in China, which is up to 20 million this year, and is much more than the demand for for cars in the U.S., which is only 15 million. So the longer-term potential is there. Shorter term, we've seen the pullback in the car sector, the auto sector, and we're not a buyer of GM now, but that's more of a short-term prospect than the longer-term potential.
Now, talking about Treasury yields, we have already seen the 10-year U.S. Treasury yields rise to about a 2-year high on Thursday, but then on Friday, U.S. stocks indices sold off on weak results from economic bellwethers such as Cisco and Walmart. Will this apparent potential harbinger of economic weakness affect the Fed's response to market rates or the timing of its tapering?
Well, Julian, a Fed pushback on the higher rates in the market is probably unlikely at this point. And now we're seeing part of this transition. We're transitioning now from whether the economy is good enough to support a reduced monthly buying to whether the economy is not bad enough to prevent reduced monthly buying. And that is an important transition. Unless the U.S. slips back into a recession, rates will continue to be normalizing, and I doubt the Fed is going to stop that trend. Even if the rate were to go up to 3%, that still would be below 3.22% average, which occurred from mid-2008 to mid-2011. And back then, our economy was in much worse shape than it is now. So I think it's going to take time for us to transition to the total support of tapering. But the process has started, and I don't think the Fed is going to stop.
And the tapering talks are really troubling emerging market currencies like the rupee, the Indian rupee, that is, and the Brazilian real. Are emerging markets in danger of repeating the 97 Asian financial crisis?
Well, there is a lot of stress. Looking at India, the rupee is under stress in any case. The trigger for the stress is somewhat internal, but the real challenge is domestically. Recently, like the release of this relatively strong U.S. data that raised the expectations the Fed is going to soon taper its monthly bond buying program, yes, that's the external trigger. The anticipation has prompted an exodus of funds from many emerging markets, including India and Brazil, which until now had attracted many investors hungry for yield because of the ultra low U.S. rates. But each country has its own internal challenges. In India, there's a growing skepticism about the slow pace of domestic Indian reform. There's also a growing concern about the obstacles facing direct investment in the country, both domestic direct and foreign direct investment. And government attempts so far to reduce the current account deficit and protect the rupee have been inconsistent and haphazard. So there is some doubt. Now you look at Brazil. The Brazil real has also suffered, and suffered much more than its peers, as the deteriorating prospects for Brazil's economy have added to investor nervousness. They have more of a trading concern. So far, Brazil's central bank has provided a hedge against a further depreciation by selling currency swaps rather than using its foreign reserves. The strategy will no longer be enough, however, because the companies who have needed the hedge have already put the hedge in place. And at the same time, the real spot market is also lacking the liquidity it needs. So the central bank is focused now on rolling over its 100,800 swaps, that's worth about $5 billion US, that will mature in September, in about 2 weeks, in order to prevent increasing pressure on the exchange rate. This rollover began on Friday, and they were successful in rolling over about 20% of the total. They still have more to go. They also injected an additional $1.08 billion that will come due this November and also next April. So they're at a different stage of progress, and that really is going to be the challenge for Brazil. Yes, the fact that the U.S. is announcing a tapering and a modification does create the external trigger, but longer term, the challenges are much more internal.
Gold remains contentious. The bearish views are dominating, but strong physical gold demand are causing a rebound in gold prices. There are some who say that a short-term bullish gold movement often correlates with the Denver Gold Forum in September. Can you shed some light on this, Dodge?
Oh, sure. There is a coincidence of timing between the current strong gold demand and the fact that the Denver Gold Forum is less than a month away. We suspect there will be increased interest at the forum, but really the stronger demand results from the current attendant circumstances of not only the gold market but also all the competing products, including stocks. As the concern for our Fed's QE tapering has increased, gold has reasserted itself as the alternative asset to both bonds and stocks. And the daily correlation between gold and the S&P 500 has turned negative. Gold is going up, and the S&P has been under a lot of pressure. So now, instead of the one negative story about gold, there are really two stories. Yes, John Paulson, the big gold investor, has sold half his gold ETF positions along with George Soros and Daniel Loeb. But at the same time, consumers have purchased 53% more of the physical tons in the second quarter than the same time last year. And we saw in a recent Bloomberg report that showed gold traders are now more bullish about the near-term gold prices since they have been in early March of this year. From a technical view, although we are still moderately negative longer term, the shorter-term outlook continues to shape up, and gold has moved above that 1,350 level we've been talking about recently. We now rate gold the commodity in stage 4B-. So it really hasn't moved into stage B1, which is the beginning of the uptrend, but the probabilities now are quite high that it has finally seen the low for this cycle. The next resistance we suspect will be near the 1,400 area. So the story is much more constructive, and with that transition to a more constructive story, Julian, it makes it harder to make money on the short side.
Thank you, Dodge, for the update. That was Dodge Dolan, Chairman and Chief Investment Officer of Lander & Fuse Capital Managers in New York on this morning's Market Watch, BFM 89.9.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.